Good evening, everyone. Thanks for joining us. My name is Matt Kopchak. I'm the Vice President of Operations with Worth Ross Management Company, and I'd like to welcome everyone tonight to our August speaker series. Those of you that are joining us for the first time, thank you. And those that are returning guests, welcome back. The speaker series has been a huge success for this year, hosting them virtually. And for those of you that are new, this is an exclusive opportunity to hear from industry-leading experts. We hope that you all gain some valuable insight, learn about best practices, and have the opportunity to ask questions throughout the evening. Our guest speakers are carefully selected and familiar with the specific needs, challenges, and opportunities that association boards and managers are faced with. Hi, Rod. Thanks for joining us.
Thank you.
All right, we're just getting started, so bear with me a second. As a reminder to everyone on the call tonight, we are recording this. We will make this available to all the board members and our team after the event is over. Nicole will distribute that. And with that, today's topic we're going to cover is called, Is Your Association Covered? Common questions about insurance answered. Everything you need to know to pick the right insurance coverage for your community. So tonight's format is going to be a little bit different than previous ones. It's going to be a panel. And so with me tonight, I have Rod Medlin, Bob Mitchell, and Kelly Buchanan. So Rod Medlin is the principal at Scarborough Medlin and Associates and has practiced association risk management and associated insurance placement since 1989. Rod has been a partner to WRMC for the past 12 years. Scarborough Medlin is one of the largest providers of such specialized services in Dallas, serving over 1,100 association clients. Next up, we have Bob Mitchell. Bob is our VP of Engineering and Risk with Worth Ross. Bob supports the WRMC clients by helping with insurance claims, reviewing association insurance policies, conducting building inspections, and developing standard operating procedures for our associations. Bob is also a licensed property and casualty adjuster for the state of Texas and a certified licensed FEMA National Flood Insurance Program adjuster, and has been an independent adjuster for over 15 years. And we also have Kelly Buchanan with us tonight. Kelly is the president of Proper Insurance Agency. She's been in the insurance industry for over 20 years. Proper's mission is to deliver high quality service while also mitigating risk and concentrating on the individual insurance needs of our association partners. As a boutique agency focusing solely on association risks, Proper is able to provide unique solutions and specialized programs tailored specifically for each client. So welcome everybody. What we're gonna do is jump right into some questions that were submitted ahead of time. Throughout the evening, if anyone has questions that they would like answered or clarifying questions on anything that was discussed, feel free to chat that in, or you can raise your hand and we'll give you the floor for a minute to ask your question live. So with that, let's get started. And the first question that came in, this one is going to be for Rod first, and then we'll go to Kelly for the same question. The question is, can you provide an overview of current market rates and underwriting capacities by risk type?
Yes, that's not, as a matter of fact, that's very simple. The capacity is relative to losses, and everything with a roof, the more roof square footage, the higher the rate. That's the way it essentially works out. It also affects capacity, people's willingness to take risk. 5 years ago, a $20 million or $40 million property pulled down the best rates reinsurers would allow. Today, if you've got a $40 million property, when the underwriters look at that, they don't see $40 million property, they see $6 million in roof losses. So the capacity is down to we have about half a dozen competitive carriers for garden style for mid-rise that is not fully sprinklered. And then you change gears and there are only about 3 that will do the high rises over 7 stories. From a capacity standpoint, I have seen and have been encouraged here in Vegas. Last night I had dinner with a strategic partner and they're about to kick off a new program. It's limited to Minnesota, but it's competitive. And this is the first time in life we've had in at least 3 years. So that means there's an insurance company with capacity that wants to write business. That's good. You have to keep that fixed in your mind, because otherwise they kind of look at us like bag ladies. We have had to put together limits. In some cases, it takes 3 carriers, where we've never had to use but one in the last 15 to 20 years. So I'm not going to say it's going to get better in the next 90 days, but I think that maybe by 1/1, when they get their results from for year to date for 2021, I think we might see, the first thing we'll see is the terms and conditions improve. We'll see the wind hail deductibles come down. We'll have split deductibles like wind deductibles or hail deductibles or separate deductibles. There will be things to spice up the offering. And the last thing that'll happen is the rates. But, right now there's a lot of capacity at work in the world. And that means there's a tremendous amount of capacity with reinsurers. But if they make money, then we get a break. If they don't make money, then we continue to wear masks and stay locked in our bedrooms for the next foreseeable year. But otherwise, I do think that we've kind of hit a plateau, and I hope that I'm right.
Thanks, Rod. Kelly?
Yeah, I would agree with what Rod said. We know that the market's been extremely tight in the habitational space. There are only a handful of carriers writing both the mid-rise or frame older garden style communities. There's a handful that will focus on the high-rise concrete steel construction. So he's right in that regard. And I'm hoping that changes too. We've seen some programs that have gone under, and over the last couple of years, we've had to move those clients to a different carrier. As Rod said, we're having to layer coverage with multiple carriers, and that's always confusing for our clients, and we have to explain that to them. But the capacity hasn't changed in the last couple of years, and I'm hopeful that we will have some new players in the space starting next year. Like he said, getting hit with the winter storm recently and some of the things that have happened, it's kind of put a big question mark on our market, but hopefully things are looking up, and we'll see what 2022 brings us.
All right, thank you.
Also,
Go ahead, Rod.
if I may, the subject of buy downs, I was recently really put under the gun at a meeting, at a high-rise board meeting. And we went through all the machinations of the buy downs and the expense and the various things. And finally, the president, who I've gotten to be friends with over the last 10 years, just stood up and said, "Rodney, what should we do with the buy down?" And I said, "Rick, I wait till I get the buy down quote to decide that, but I've got the buy down quote. The buy down people are betting you 20 to 1 that you're going to have a loss or not going to have a loss. I would take those odds on a buy down when you've got a association that's well financed and well reserved, and everything's healthy. It becomes a matter that Worth Ross can walk through in his mind and figure out, including your interest, on his cell phone in about 2 minutes. I mean, financing that if you did take the hit is not the end of the world. So I look at the buy down, I figure out what kind of odds they're giving me, and then if somebody forces me to say what I do, if it's 20 to 1 or better, then I'm good. I'll take my chances. So that's my answer on buy downs.
So thank you, Rod. You kind of jumped in a little bit ahead on the question. The question that was going to be asked was, with increasing weather damage, what is your opinion of the cost benefit of insurance buy down? So I believe you covered that. Kelly, I don't know if there's anything you want to add or not on that question.
Yeah, I think that when it comes to buy downs in a particular, association, it kind of depends on their budget and their financial standing and what they feel comfortable with. Ultimately, it's, what do you feel comfortable with as far as retention is concerned. We've seen these wind and hail deductibles go up into the percentages. It's no longer a flat deductible for some of these buildings. We have one carrier out there that's still offering that. The rest of them have all gone up to at least 2%. The Lloyd's market has gone up to 5%. So if you're comfortable with spending, the premium dollars to buy that deductible down, then I think it's a great thing, but it's not necessary for every association. It's definitely a case by case issue, depending on what's being offered by the carrier and what the board feels is best for their particular association.
Does it ever make sense? Have either of you seen in your experience it makes sense to, I mean, these deductibles are getting higher and higher and higher to the point where you're almost self-insuring. I mean, have you seen anyone decline coverage yet in your experience?
No, we haven't. And the reason is because every owner's got a lender and they'll just not allow that unless you're Buffett or somebody like that could put up $1 billion profit and loss. So no, nobody, I mean, you'll get every mortgage called in town. It's amazing how fast they can move.
Mm-hmm. Cool. Thank you. Kelly, anything you want to share there?
No.
Okay. Bob, is there anything you'd like to chime in on the first two questions?
No, I'm going to let those agents talk about market rates and underwriting and cost benefits. I'm going to let them do that. I'm going to talk on the insurance adjuster side.
We'll get there. Thanks, Bob.
Okay. Yeah, sure.
All right, Kelly, this one is for you. What level of premium increases are we likely to see from Winter Storm Uri? Also, any insurance changes from the Surfside collapse that we should be aware of?
So the winter storm has been the topic of conversation since February. I think we've all been looking for guidance on that. Everyone has been wondering what's going to happen in the market specific to that winter storm. So I reached out to some of our carrier partners just to see what they had to say about it. And depending on who you ask, you might get a different answer. So for example, from Philadelphia, their response was that, with renewals on clean accounts, the rate increase may be 10 to 15% and up to 30% rate increases on accounts with claims. They are also expecting to raise their AOP deductibles and their wind hail deductibles. We've had other carriers come back and say that they may do better on wind hail deductibles next year, as Rod had mentioned. Particularly with the high-rise buildings, Wesco has said that they are not going to negatively surcharge for anyone that's filed a claim with the winter storm. However, they are filing for just a standard across the board 5 to 10% rate increase. We'll see if that comes to fruition. They have to file that. I think that we are going to see some increases. We have seen those in the past couple of years. I don't anticipate in the high-rise market for it to be substantial. I think when you look to the surplus lines market, on some of our older frame style condos, I think that we will continue to see a bit of a rate increase. I have told managers to budget around the 20% mark. Could it be higher? Yes. If you have any questions specific to your condo, you need to look at the claims history, talk to your agent about it. You might be able to drill down on a better number there for your budget. As far as the Surfside collapse is concerned, I think that it brings up more or less, we want to start looking at coverage there, and collapse generally is excluded, and then you have some additional coverage added back in for collapse. As far as what happened there in Florida, it's really going to come down to what actually caused the collapse, and they're still investigating that. They have some ideas. There's several theories floating around, lots of, finger pointing, but as far as how the coverage is going to be handled and the payments are going to be divvied out, it's going to come down to what caused that collapse. When we look at our buildings here, we want to make sure that there's enough coverage there. It's believed that Surfside, that it was underinsured. We want to make sure that not only the building coverage is adequate, that the liability coverage is adequate, the debris removal coverage, the ordinance or law, those are all things that play into a catastrophic loss like that. So at your renewal, you need to sit down with your agent and really drill down on those coverages and make sure that they're adequate so that you don't find yourself in a position like they are. You can't insure against every possible thing, but as a board, you know, as having that fiduciary responsibility, you do want to make sure that if the coverage is available, that it is explored.
Along the same, since a question was chatted in that is directly related to Surfside, it says, I don't know if you can see it, but how has the recent tragedy in Miami affected underwriting for high-rise communities? For example, will insurance carriers require a structural integrity study by a qualified engineering firm?
So we have seen in Florida that a couple of the carriers there are expecting the boards and to have these studies done. Now, you know, when the insurance carrier comes out and does their inspection, they may have their own recommendations, but it's not typically a thorough engineering study on that structure, on the structural integrity of the building, especially some of these older buildings. You really want to have qualified experts that come in and do that. And it's yet to be seen whether that will happen here in this market. I think that in talking to Great American this morning, you know, their feedback was we haven't set any specific parameters around that quite yet. That's to come. I think they're also waiting to see the specific cause for that collapse. As we know, this is not something that, you know, happens regularly. It's not the first collapse that's happened. It won't be the last, but fortunately, it doesn't happen often. So as far as, you know, changing the underwriting requirements for the entire industry, it's yet to be seen, but I do think that it's a good idea to explore, especially in older buildings, explore the option of getting on the right side of things and making sure that we do have those reports done and have that in our wheelhouse so that we understand what the liability is of any particular building.
Thank you. Rod, anything you would like to contribute to Kelly's response?
Yeah, I don't believe, and I served for 10 years on the AFM National Advisory Board, and we'd go to usually Boston or Goat Head Island, Rhode Island, and meet. I've had my troops, my team of 5, all trained at the AFM high-rise HPR facilities, and we communicate a lot with them, and I don't believe you're going to see anything change at all from a property standpoint, other than you're going to have people, if they're in an area that has underwater subsidence issues like Surfside, along with water table issues, along with building code violations, along with no AMO, no management company, no guidance other than an in-house manager, they're going to want more or not write them. But by and large, it'll be about the same. My big concern is really for the manager himself in this case, because if you worked at Surfside, they were self-managed. I have friends all over the country that do this because I've been doing CAI stuff for the last 30 years. And I have friends in Florida, and I know they were self-managed because I know management companies were uncomfortable. So that's not a good sign if that's what the industry scuttlebutt is. And my question would be, at what point does it cross the line when these crazy, wacky judges decide that manager killed all those people for not acting on information that was, well and truly known? And that concerns me. And I'm really proud of the management companies in Houston because they said, guys, you guys got a problem you need to fix, to the point that they didn't want to be there. So the GL is going to be affected. GL carriers we could get 20. Kelly, don't you think I could get 20 GL quotes? On high rises, I think you're going to be doing good to get 4 now.
Mm-hmm.
So it's not a good thing, and it's going to make them look twice, and you're going to be asked so many questions. And I base that on, we insure about 60 high rises, and I can tell you right now that it's changed in complexity.
All right. Thanks, Rod.
Yeah.
There's a question that came in that goes back to your response that you provided for the second question this evening. So I'll come back to you real quick on that. The question asks, we have some new board members on the call. The question is, can you explain what the term buy down is?
Buy down is simply, buy down's not insurance. Buy down is speculation. It could not be categorized as insurance, but what it is a bet. And what they're betting, you can figure out what they're betting by dividing the top line into the bottom line. If it's a $2 million buy down and it's costing $100,000, then it's $5,000 a million. You got to get to 2 million. It would be about $110,000. And it ends up being, in this case, about 20 to 1. And some of my biggest ones, 20 to 1 is about the average number that we end up seeing. So you take the amount of the deductible, and then it's going to be 20 times smaller than the principal amount. And that just means they're betting 1/20th of $2 million that you're not going to have loss. And those are pretty good odds if they're risk, if it can't be avoided, and you cannot avoid it, to the point that we've insured most of the big school districts in this part of the state for the last 22 years. And it's just hard to get anything to deal with a $2 million or more deductible. My recommendation is not try it. Because 20 to 1, I didn't tell you what the number was, but it's considerable.
Rod, so the term buy down means that their deductible is 1%, and that 1% equals $1 million. They are then paying a fee on the front end to buy down that deductible amount. Am I understanding that correctly?
Right. What they do is they have line slips that sign on to the bet. I call it the bet. And if it looks like a good one, if you've got somebody that's just a powerfully structured high rise, like a lot of the ones in Dallas, a lot of the ones at Worth in the guy's handle, then they're willing to take that bet. Our high rises in Dallas will generally withstand 110 mile an hour wind with no appreciable damage. So the wind is not so much the concern as the hail. And the hail is mitigated by the roof size, because in the case of Wesco, if you've got 25,000 square feet of roof or less, they will give you the best deductibles and no water deductibles in Dallas right now. But that's their peculiarity.
Okay. Got it. Thank you, Rod. So
Yes.
There's a couple questions that came in, but I want to move through a couple more of these that were submitted ahead of time. And one of them actually will piggyback off of a question that was submitted. So Kelly, this one's for you. Should an association make condo owners aware of, quote, loss assessment insurance? What does loss assessment insurance policy cost? What does a loss assessment insurance policy cost?
Sure. So yeah, I think loss assessment coverage should be, in my opinion, a necessity for the unit owners. It's something that they really want, and it's not expensive at all. It can run you anywhere from $10 to maybe $50 a year, and you can get limits up to 100 grand. I've actually heard of some carriers going higher than that. And basically, if there is an assessment, you can file against that policy. I know that when we do presentations for unit owners, we will present them with a guide to the master policy, and it kind of explains how their coverage fits in with the master policy. And you don't want to have any gaps between the two if you can help it. And one of the sections we go over is loss assessment coverage. My suggestion would be to talk to your individual personal insurance agent, ask them about loss assessment coverage. Most policies have a small amount built in, but it's very small. We're talking anywhere from like $500 to $1,500. You can raise that by endorsement. And like I said, you can raise it up to perhaps $100,000 for a really nominal premium. So my suggestion is to take the highest limit that your carrier will offer.
Okay, so piggybacking off of the loss assessment topic, sort of, this is a question that came in. So is there ever an argument to be made for saving your premiums on the association side by moving to a very large, let me reread this. Is there ever an argument to be made for saving on your premiums by moving a very large deductible, essentially shifting some of the insurance burden to the individual condo owners through their individual policy or utilizing their loss assessment coverage?
I think that you have to be a little careful when you talk about basically increasing the deductible and shifting the burden to the condo owners through their loss assessment coverage. And the reason I say that is because there are some carriers out there that have an exclusion within their loss assessment provisions for deductibles. Now, it's not often. Most of them will cover that if it's for the master policy deductible, but some of them won't. And you might ask, well, when would you use loss assessment? Well, there are many other times that coverage would be utilized outside of a deductible. So you do have to be careful there. As far as the question about moving to larger deductibles and shifting the insurance burden basically back onto the association or the unit owners as a whole, I mean, you definitely can, and we have been doing that, maybe against our will a little bit. They have been increasing these wind and hail deductibles up into these high percentages. And most this year, I've noticed, have not been taking the wind buy down policies because they're expensive, and they have been taking that burden, if you will, on themselves. And there's a couple of things that you can do. You can look to increase your reserves and prepare for having to pay out that deductible in the future. I think it's something that you should sit down and talk with your management company about, obviously talk with the board and find out what their capacity is and have a plan moving forward over the next 5 years to prepare for these increasing deductibles.
Great, thank you, Kelly. Let's see. Go to a couple questions that came in as well, because they kind of tie into conversations we've already had. So Kelly, if you want to go first on this one, what is your advice regarding property appraisals?
For replacement cost appraisals, my advice has been to do your research, and ultimately what we've seen with case law is that it does fall on the board. There's been several incidences out there where it's like, is it on the agent? Is it on the board? Who does the responsibility fall on? And ultimately, it's the board's decision where they place that TIV. But I always suggest getting a replacement cost evaluation done, and I would suggest doing it at least every 3 years. What we've seen recently, if you notice, the cost of construction has gone up significantly from 2019. That was just a couple years ago due to the winter storm, due to COVID. It's hard to get supplies. We have buildings that just can't be repaired at this point because of the demand for supplies and the backlog on that. So the cost of construction has gone up significantly. And I have buildings that did their replacement cost evaluation last year, and they're already looking to do another one because they want to make sure that they're adequately insured. We have some tools within the agency that we can use to help come to that number, but I always suggest, having a third party look at that as well. I think that it's important for the board to be able to show that they have done their diligence in that regard.
And the cost of those appraisals is to the separate and aside from the premium to the association in most cases, or in all cases?
Yeah, if they're getting a third party assessment done, the cost generally runs, I've seen it run anywhere from $400 to about $1,500, depending on the size of the building and the detail that you're wanting within that report.
Okay. Perfect, thank you. Rod, I'm gonna come to you on this one. This is a question that was chatted in. This goes back to the reply you had given related to the Surfside tragedy, and it ties into, I guess, binding coverage. And the question is very straightforward. Is the board of directors liable, I guess, for either or underinsuring, not having adequate insurance? I'm kind of reading into the question, but go ahead.
Sure. The board is ultimately responsible for picking the number, and I have commissioned and received now a white paper done by Hallett and Perrin, by my corporate lawyer, addressing the decision on the total insurable value amount. And what I believe I'm going to do first is publish that to Worth, Ross people, and then I'm going to publish it in LinkedIn, because that has been the question in so much litigation in the last 2 years that I don't have words to describe it. There has not been a loss in the last 2 years where the board didn't try to sue somebody because everything is inadequate, the limits, and you're just going to be faced with that. We do provide a RCV appraisal. It's it's a Marshall and Swift is what it is, CoreLogic. And that gives us the current values and tells us that we're within a standard deviation of what's right. But this COVID has thrown costs completely out of whack, because in some cases, plywood that was formerly $18 a sheet is now running 110. I've got a builder friend that Terry told me, he said, Rod, I can a custom build. I'll buy $70,000 package and I've got it knocked. And he said that was a year ago. He said, now I'm paying closer to 160 to 180 for that identical package. So what's really sneaking up is the cost to get it fixed. And so we do insist, for our own protection and the management company's protection, but foremost for the board's protection, to give them a firm place to stand and fight if there ever is a dispute, because the first thing ownership's going to do is point the finger and at the board. And the board's got to be in a good position and have well communicated the issues at hand and the impact and potential cost of the things that it presents, and be ready to do that. And we arm the board with the things they need to keep themselves out of trouble. I recommended every 3 years on high rise, 5 years on garden style. But right now, everything in Dallas, Texas is underinsured unless we have renewed it in the last year. I think everything in our agency, and that's over a couple of hundred, are good. But it's been something that my team of 5 and I work on day in and day out, to the point that it's almost discouraging. But we have now got a good place and we have good answers, and we need to protect everybody involved. So some kind of rules of the road would be helpful, and that's what I've tried to put together on that question. As far as loss assessment, to just go back a second, the place that we see it used the most and the place that we use it the most, AFM told me, Rod, there's high rises are not ever going to quit being built because of wind or hail or any kind of windstorm. He said, if anybody quits building them, it's going to be because they were destroyed by adult diapers. So since the top peril in a high rises property menu is flooding, what we've seen done, and I can give you an example of one right there in Dallas, everybody in the building agreed to $15,000 per unit water deductible. And they bought that much assessment coverage, and the carriers adjusted their limits accordingly. And that's per unit. So that's so much better than 150,000 aggregate deductible that it just, because normally the average water loss is about $18,000 in my experience. And so if there's a $25,000 water deductible on the master policy, what they've done is underwritten them out of the working layer. And so what we try to do and have to do, like Kelly described earlier, she's probably more knowledgeable about it than I am. But if you watch the form, you can mold your loss assessment with water which is the second most likely thing to happen and probably the biggest cause of what rate increases we have seen in the high rises. And boy, have we ever, from 5 to 10 to 12 cents.
So Rod, are you, in not so many words, are you suggesting that it's probably in the best interest of all the, at least the North Texas buildings, to have another appraisal done this year, even if they had one conducted in 2021, or I'm sorry, 2020?
Yeah, yes. I just got to be honest, because the insurance companies are fighting tooth and nail in court.
Okay. Okay. Thank you.
Yes, sir.
Bob, let's shift to you here for a second, and let's talk about loss assessment coverage. We actually have a question that was chatted in, so I'm going to add it to your question here. So why is it important to have the correct loss assessment coverage in place? And then could you give an example of what an owner might claim with that coverage?
Sure, absolutely. And so Kelly and Rod have already covered parts of it, but loss assessment coverage is actually an endorsement to condo unit owners' HO6 policies. It's actually an endorsement that has to be purchased through your agent.
So that would be in addition to the HO6.
That's exactly right. That's exactly right. So it has to be purchased by the unit owner. So, but there is a big need for more education and information to the unit owners, regardless loss assessment coverage, in light of all the deductibles and how fast they're going up. Wind and hail and water, they're all at rates that we've never seen before. So, but the actual definition of loss assessment coverage is optional endorsement then can be added to an HO6 policy. That's the actual definition of it. So, but it also helps in addition with the HOA insurance policy, because it provides protection to the unit owners when they are responsible for a portion of either that damage or loss, either to a common element from a peril insured against. And that's the important part there. That's where loss assessment coverage comes in, from a damage from a peril insured against, whether it's wind or hail, water, smoke, or fire. And so we have to have special form coverage and expanded perils. And we also have to be RCV. So, but based on those rising deductibles that we have, the wind and the hail, like Rod said, Rod and I know for sure, we have a building that has $2 million deductible for hail. We know that. The association HOA boards, they may not have even a choice to assess unit owners for the cost of either that deductible or the repairs after the damages from one of those perils. So basically, like has been said before, HOA associations are now, they're self-insured for wind and hail damages. That's where we are. But when the HOA board does assess a unit owner for a large repair, either to a common area, maybe a roof damage, water leaks, roof leaks, or maybe just a high deductible, and it's from a peril insured against, and if the unit owner has the proper coverage on a loss assessment endorsement, then that unit owner files a claim on their HO6 insurance policy, and they get reimbursed for the value of that assessment. And then they just take that check and hand it to the HOA president or to the general manager. And they've now paid their assessment. So most loss assessment endorsements don't even have a deductible for the unit owner to pay. There is no deductible. So we highly recommend that unit owners add loss assessment coverage endorsement to their HO6 policies and discuss the proper amount of coverage with their agent. That's a big deal. But also taking into account, let them look at the current insurance policy and find out what the deductibles are. That only makes sense. And then also loss assessment coverage now should be reviewed on an annual basis, because the insurance policies only last for a year. Well, those deductible changes. Well, let's look at those and review those before you look at your loss assessment coverage every year. Also, the unit owner's loss assessment coverage, the endorsement, that can help the HOA association not take out a large loan or large payments, or even take out money out of their reserve accounts. So loss assessment coverage by unit owners can help the associations.
Thanks, Bob. Rod or Kelly, anything to add on that topic?
The one thing that I would add is it's better to deal with an issue before it's an issue. And that's what Bob just described. And that's what a really sharp manager who happens to be with Worth now, the decision that they made and structured for that association was a eyes open, future accepting moment for that association, and it made water claim deductibles, which had formerly been a nightmare after the fact. It got rid of that problem altogether completely. Because if God wants to take your high rise, it was his to take before the materials were ever put in the form they're in. But the thing that concerns me a little bit, and this is advice that I would give you because this is advice I would give myself. If any of your new directors or officers serving on your board, you have a lot of immunities that are offered by the state, but they're not enough. And at the end of the day, in America, anybody can sue anybody for anything, and there's not a thing any of us can do about it. For that reason, if you will add personal injury protection by endorsement to your HO Condo 6, to your Section 2 personal liability, you tell your agent, I need a personal injury endorsement added to my policy. When they do that, that will give you coverage on your personal liability for any work done on a nonprofit board for which you're not paid. And then it will follow a form with your personal umbrella. In my case, I have some young men that are young drivers, and that gets to be a consideration. So the way that it works is it extends through that umbrella, and you can have as much as 3 million in limits on your personal policy and never worry about this. There are people, and we have seen it, sue board members just for whatever reason that people that are ugly do that, and it's to make them spend money. And we can solve that problem for you now. Tell your agent, I need personal injury protection on my liability, and that way you're as safe as you can ever be. And I would never serve on a board, and I have without it.
Thanks, Rod. Kelly, anything to add?
I mean, I think that there are different coverage considerations between the unit owners and then board members that are also unit owners. And then, at the master level, I think there's considerations all the way around there as far as what, Rod was speaking to. And the board members themselves, they have some unique insurability to think about because they could potentially be targeted in the event of a suit. And so there are some ways that you can better protect yourself. Like he mentioned, there are, if you sit on any board, it doesn't even have to be, a condo association board. You sit on any board, you should look at personal D&O coverage. I mean, there's a lot of things that we can talk about, and I don't want to get too far off topic, but I do think that it's important that when the coverage is available to you, that you take a look at it. I know someone chatted in asking about would having PIP coverage encourage lawsuits even more. I think it's hard to get into that game of saying, well, we don't want to get the coverage to encourage lawsuits. I don't like going down that route. I think it's better to have coverage in place. And of course, I have my insurance agent hat on when I say that, but I do think it's better to be protected in the event. I mean, we live in a very litigious society. And so I think that, putting the coverage there, especially when the premium is nominal, to add those endorsements on there, I think it's really important, and everyone should be taking a hard look at their coverage and making sure that they're insured. We have enough going on right now out in the world that, it's one less thing off your plate.
Perfect. Thank you. Let's go, Kelly, I'm gonna ask you to chime in on this one first, and then we'll go to Rod. So how are the rates negotiated when it's time for renewal or going out to market? Could you walk us through the process that a board and or a manager can expect?
So I would say that your rates are highly dependent upon your building and your claims history. I mean, there's a lot that goes into it. It's not just a cookie cutter way of doing things on the commercial side. If you notice, for your personal insurance, you can jump online and get a quote, and it spits out a number, and you can even bind your coverage right there online. When it comes to association risks, they are more complex. There's a lot that goes into it. The underwriters, depending on the carrier, they have their unique set of questions to see if that risk fits within their appetite. And it's different for every carrier. It differs from state to state. So what you'll find as a manager is you may be asked specific questions, you know, from one carrier and a set of different ones from another, but typically they're looking at things like, you know, the construction type of the building, the age of the building, how many units, how many stories, is it sprinklered, what type, you know, the roof line, like Rod mentioned, how big the roof line is a huge deal in North Texas due to the wind and hail. So there's lots of factors that go into rating each individual risk. And at renewal, they're obviously going to look back at claims history from the prior year. Did you file any claims? What type of claims were filed? What is the market yielding right now? Have we had any catastrophic claims? Just like Uri, that it's going to be, you know, a factor in the renewal rates coming up. So lots of different things go into it. You can drill down some specific items within your association, depending on your geographical location. If you have certain questions around your renewal process, I think it's good to ask those well in advance of the renewal. Typically 90 days at least is when we start looking at that. Yeah, Rod, do you have anything to add on that?
No, not really. Right now, the best place to be is where you are. Just hold your breath. Try not to have losses. And your carrier that's got money in the bank is always going to be your best port in a storm. So always be kind and reverent that you've got insurance a little bit. And then just be prepared to stay put if you can. And in 85 to 90% of the time that a holding carrier offers a renewal in a market like this, it's going to be best. It just is. And the other market, the market that's out there that we have to market to, have become almost usury. The reinsurers have, not the carriers. We have good carriers to whom we're loyal and grateful and appreciative, but the reinsurers don't know us and don't want to know us. It's all a matter of profit and loss to them, and they want to make as much as they can for the next time that the clouds get dark. And so it's a quiet sea is a good sea. And so I just hope everything floats along smoothly.
All right. Well, let's see. We have about 10 minutes left, and I have a couple questions for Bob I want to get to. So Bob, what does ALE stand for in your HO6 policy?
All right. Well, so ALE coverage is called additional living expenses. And ALE refers to the coverage under a condo unit owner's HO6 policy that covers the additional cost of living incurred by a policyholder should they be temporarily displaced from their place of residence. That's really kind of the definition. So additional living expense coverages, it reimburses a unit owner for extra expenses that they incur if they can't live in their home due to a covered loss. That's very important. ALE coverage in a homeowner's policy covers things like, well, additional transportation, the additional cost of maybe you have to go out to restaurants and eat versus cooking at home. Well, the difference between those two is covered. And of course, temporary housing with a comparable standard. And that's really important. standard of living while the repairs are being made in the unit. So the limit on ALE coverage is normally about 50% of personal property limit, but ALE coverages can differ by carrier. So the unit owner's agent can properly describe the coverage that's available in their policy, and that's important to have that conversation with the agent. But remember that the association's insurance policy does not provide coverage for ALE for unit owners. That the unit owners must file their own claims on their own HO6 insurance policies when there are substantial damages to their unit and they need to use additional living expenses. So that's what those are.
Thank you, Bob. How about the topic of improvement and betterment coverage? Why is that important to have?
Well, it's really important because the HOA Association's policy only covers back to original construction. So currently we're involved in 31 Winter Storm Uri claims for all Worth Ross management associations. We have 31 claims we're dealing with, somewhere between 350,000 and about 1.5 million. So every one of those, the HOA policy only repairs back to original construction. Well, what about all of the upgrades? So remembering that only back to original construction, let's give an example, maybe carpet and pad for the flooring, or maybe like a builder grade or a standard grade kitchen cabinet or vanity, or maybe just like solid or roll top countertops. Well, you know, there's upgrades, engineered wood floorings, bamboo floorings, high quality kitchen cabinets and vanities. You know, we got marble and granite countertops. Well, those are considered improvements and betterments, and they have to be filed on the homeowner's HO6 policy. So improvements and betterments are not covered by the HOA insurance policy. They're not covered. And we're dealing with that right now on a large number of units for these 31 associations that have damage from Winter Storm Uri. So that's exactly why improvements and betterments, that it's very important that each unit owner gets with their agent. They identify what are improvements and what are betterments and what are the values of those, so they can be properly insured and covered on those. Now, also along those same lines are contents and personal property. So if you take your unit and you take it and you shake it and you turn it upside down and shake it, whatever falls out, those are contents. So, and I think that's except the refrigerator and freezer. Is that right, Rod?
Yes. Well, if it's attached to the building,
Yeah.
permanently attached to the building, then there's a good chance it's going to be covered under the master. But if it's an upgrade, you're not going to get. I'll give you an example. There's an insured of mine in Dallas, where one unit has walnut paneling that came from the original Lloyd's of London, and it's 200 years old, and they've appraised the wall covering in the living room at about $200,000. Well, that's just not the association's problem. And like you said, I've seen alpaca carpet. I have seen everything from exotic birds to handcrafted leather, applique floors. So I have seen floors that were astronomical. And I learned early in my marriage from my wife that every window requires a window treatment, and the difference in curtains in a window treatment's about $1,800 a window. So you got to think about that part too.
That's right. That's right. Well, now remember that homeowners' personal property and contents, they're not covered by the HOA policy, the association policy. So if a homeowner's personal property or contents are damaged from such perils like either water or smoke or fire, then that unit owner should call their insurance agent and discuss filing a claim. How much is damaged? What's that worth? What is the deductible? Is it worth it to file that claim? So Some of the other things, as far as endorsements are concerned on those HO6 policies, we also want to be sure that every single endorsement, every HO6 policy, that it's a RCV, a replacement cost policy, not an ACV. Also, you can get RCV on improvements and betterments and contents if they're available from a carrier. And every one of those policies should also include a special form coverage that it includes expanded perils that are insured against. And that's very, very important. Okay.
All right, so we have a couple minutes left. Bob, you want to wrap up these last two questions and we'll see where we're at. It is why, can you explain the WRMC insurance claim process and procedure SOP? And then also explain the water and flood emergency program that you've developed and rolled out.
Absolutely. I'll just do it real quickly. So the WRMC insurance claim process and procedures is real simple. It's based on what happened several years ago when an association filed 7 claims in 18 months. I know Rod's batting his eyes right now, but 4 of those were barely above the deductible and the others were just about a $5,000 check. So the problem was the price of the renewal policy almost doubled. So we applied some rules about a common sense approach to resolve the claim issue. And it says, look, the first thing we're going to do is we're going to gather information. What was the cause of loss? Where is it? Was it a broken water line? Grab that water line and hold it for evidence. What's damaged? Is it the common areas or the units? And then get a ballpark number. What's the damage for the restoration, mitigation, repairs? How much is that cost going to be? Now go to your insurance policy and look for coverage, but also go look at your deductible for that peril. What's your water deductible? What's your wind or fire? What's your fire, which is an AOP deductible, all other perils. So is it worth it to file a claim? Also invite your board to be part of that decision. Call the old risk management department and Bob will help you. And this is just a simple process that helped eliminate a lot of bad claims over the last few years. The last thing is the WRMC Water and Flood Emergency Management Program. It's our standard operating procedure. This program was created by a request from Worth Ross himself. Worth had seen so many associations that were greatly damaged by water. And he told me what he wanted is a program to protect our buildings, our residents, and our employees. So we put a program together that addressed this goal. And the goal is, if the water's leaking, know how to shut it off regardless of where it's leaking. Have a plan, know the procedures, know the locations of every shutoff valve in the building, know the process of how to shut down the water at our mechanicals and equipment without damaging that equipment, and then stop the water as soon as possible to prevent additional damages. And have the equipment needed to shut off that water, whatever that is. Have ladders available if the valves are way up in the stairwells. Train everybody, concierge, management, engineers, personnel, maintenance. Build some books and show the program to our insurance inspectors, which will drive down our water deductibles. And that's already happened in several associations. So, but that's just one of our SOPs that help protect our building. So it's 601. So I'll send it back to you, Matt.
Thanks, Bob. So there, if anyone needs to go ahead. But there's 2 questions that I would like to get answered before we log off for the night. So
Sure.
the first question, this will be for Rod. So this is from an association board member. Our bylaws stipulate HO6 policies are mandatory and the HOA has the right to purchase and bill the owner directly. Should the HOA require proof of the HO6 policies?
That's a provision of the bylaws?
Yes, that's what I understand from the question.
You can't buy insurance on property that you do not have insurable interest in. An individual could not buy insurance on my house. However, I think when you're in an association, that the association gets a certain amount of a vote And it depends on the language in your decks and bylaws, how enforceable it is, because there are people that'll just put their foot down and say, hell no, and be desperately trying to find somebody to pay for the claim that they did not insure. And we see this happen frequently. Not frequently, but not never. Let me tell you, we get one at least a year where it kind of went wrong that way. But from a standpoint of, as a manager, I think that probably planning ahead and taking some ownership in those decisions does make an insurance company be more willing to meet you halfway.
Okay. And Kelly, last question for you and for the evening, it looks like. Can the HOA require all owners to have the loss assessment coverage? Also, when there is a covered loss, should the HOA assess the affected units the deductible amount?
So two things on that. I've been asked that before. And as far as whether they can, require them or not require them, I wouldn't want to say that that's really my wheelhouse. I think that's something that the management company and the attorneys should discuss and what they can and can't do. So that would be a question more for them. However, if you are able to put some mandates in there on coverage, I think that that's good. We've had associations specifically ask if they have, a dog park built into their high rise. Is it good to mandate a certain amount of liability coverage? Again, that's something that the management company and their counsel should discuss and see what they can do around that. More coverage is always better in my opinion. However, what was the second part of the question?
It was about the deductible. Let me find it so I can.
Oh, assessing it to the unit owner.
Yep.
So, I think there are again, I think you need to talk to your counsel about that. There are some regulations within the Uniform Condominium Act, which we didn't get into, and we don't have time to really go down that path here, but it really depends on the claim. It depends on the circumstances of the claim as to what you're able to do with that. So it's really, it comes down to a particular claim and the circumstances around that. And again, talk to your counsel, talk to your agent, and see what your options are there.
Okay.
Okay.
Thank you. So that looks like that's all the questions, and we're 5 minutes over. So thank you everyone for joining us tonight. Nicole, thank you for coordinating as always. Rod, Kelly, and Bob, thank you for joining us and sharing all of your expert knowledge. Much appreciated.
Thank you for having me.
All right.
All right, guys, have a good night.
Bye.
Thank you, everybody.
Likewise.
Bye-bye.